You just crossed $250,000 invested, and I'm genuinely proud of you. Now let me show you the hidden trap. At this level, your brain starts lying. Tiny market moves look like spendable money, but they aren't today. A normal green day can flash thousands on your screen, and that number can vanish before next Tuesday. I've watched people hit $250,000, celebrate, then quietly sabotage years of progress with one emotional decision alone overnight. Stay with me, because the dangers here aren't crashes. They're psychological monsters that show up right now too. Before we dive in, if you like calm, practical money talks, tap like so this reaches others quietly, and comment where you're watching from, plus your milestone. 100,000, 250,000, or 500,000, so I can tailor videos better next. If a friend is stressed by daily market swings, share this with them. It might save their future. And if you want more simple investing without hype, subscribe. I post new videos that keep you steady. All right, here's why $250,000 changes everything. Percentages stay the same, but the dollars start shouting at you daily. When you see a 2% move, your brain doesn't feel math. It feels a free vacation today. But nothing hit your bank account. What you're seeing is a quote, and quotes are reversible fast again. Here's the first lie. Once the balance looks big, your mind upgrades it into spendable cash in spirit. I call this the arrival illusion, and it's deadly because you start rewarding yourself on temporary gains alone. The problem is simple. Gains can disappear tomorrow, but flights, deposits, and upgrades get paid in cash now. Once you convert a market blip into a bill, you feel lost twice. On screen and in real life, that double pain triggers bad moves, chasing quick wins, taking bigger risks, and breaking the plan that worked. So remember this line: reversible gains, irreversible spending. Your portfolio measures weather. It doesn't pay utilities ever directly. If you want real income, you need dividends, interest, or planned sales with taxes and a clear schedule. In a minute, I'll show you the guardrail that keeps $250,000 compounding without turning volatility into lifestyle creep. Imagine your portfolio jumps 2% and you see plus $5,000. Your brain labels it bonus income instantly today. Then you book a $3,000 trip, thinking the market paid for it because the green number felt safe. Next week, the market slides 4%. Your account is down $10,000 from the high and the card bill remains. That's the hidden tax. You turned a reversible quote into an irreversible expense and it compounds the wrong way. At $250,000, you have enough money to make expensive mistakes, but not enough to recover quickly from them. This is mental accounting. Gains on a screen feel like a different bucket than your paycheck and bills. It's also the house money effect. You spend or gamble more because it feels like found cash, not yours. And loss aversion makes it worse. After spending, a routine drop hurts more than the earlier rise felt good. So here's my first guardrail. Never let one good market week rewrite your lifestyle budget or commitments today. If you want to buy something big, decide the amount first, then plan a sale like a business. 2. Write down what you'll sell, when you'll sell it, and what taxes you expect before swiping any card. Then rebuild your allocation afterward, so spending doesn't quietly tilt your risk and create future regret loops again. Also, stop checking your portfolio like it's a heartbeat monitor. Frequent checking turns noise into emotion and action. I recommend a simple schedule. Weekly glance for awareness. Monthly review for contribution tweaks. Quarterly for rebalancing only. Because your portfolio is a thermometer. It tells conditions, not permission, and it shouldn't control your next purchase. When you treat quotes like income, you start living off weather reports, hoping the forecast stays sunny forever. Real income is dividends, interest, or deliberate withdrawals with a plan. Everything else is volatility wearing a mask. Now, once you accept that, you're ready for the second monster, overconfidence, which shows up right after this milestone hits. This is where people think, I did this, when the truth is discipline plus time plus market tailwinds. And with bigger numbers, That false confidence feels powerful because a good month now looks like rent or mortgage. Christ, here's the overconfidence trap. The boring habits that built $250,000 suddenly feel too slow, so you crave optimization. You start believing you can do more than ride the index because the chart looks like proof of skill. This is Dunning-Kruger in real life. Limited knowledge plus visible success creates a fake sense of mastery quickly. You shift from what you control, savings rate, allocation, time, to what you can't. Predictions, timing, earnings beats. That's when people ditch broad funds, buy a few conviction stocks, then sprinkle options to juice returns. It doesn't feel reckless. It feels efficient, like you're finally playing the game at a higher level now. But risk becomes nonlinear. One routine sector drop can erase years because the base is large enough to sting. Picture investor A. 3 tech names, weekly calls, confidence high, then a normal 15% pullback hits hard. Suddenly, $40,000 evaporates on screen. The options expire worthless, and panic whispers, "Win it back fast." That's when revenge trading arrives. Doubling down, chasing green candles, shortening time frames, and breaking every rule you had. Costs stack quietly. Spreads, taxes, mistakes, and your attention shifts from life and work to tick-by-tick anxiety daily. Your portfolio turns into a confidence scoreboard instead of a compounding machine, and that mental switch is dangerous. Research consistently shows overconfident investors trade more and often underperform after fees, spreads, and bad timing. You're not just paying commissions. You pay by missing rebounds while you sit in cash waiting for perfect re-entry. The market doesn't bill you for patience, but it punishes frantic activity when it pushes you off plan. Macri, here's my guardrail. Keep your core portfolio boring. Broad index funds, low costs, and automatic contributions on schedule. If you need an outlet, cap speculation at 5%. A sandbox you can lose without derailing your retirement. And add friction. Any trade that increases risk must wait 48 hours, written down with reasons and an exit plan. If the urge survives 2 nights of sleep, you can act, but only inside that tiny sandbox, not the core. Now the third monster is sneakier. Comparison, because once your balance is visible, other people's numbers start hurting. You're following your plan, then a screenshot appears. Someone claims $500,000 or 100% YTD, and you feel behind. Nothing about your goals changed, but your brain rewrites your pace as failure because comparison hijacks context instantly. At $250,000, differences feel urgent. Your base is big enough that gaps look like years, not just numbers. That sting pushes escalation. You loosen rules, chase hot sectors, and search for shortcuts to catch up fast. This is where leverage shows up wearing a suit. Margin, HELOCs, debt-financed investing that looks smart on paper. The pitch sounds clean. If markets return 10% and borrowing costs 6%, it feels like free money today. But debt doesn't care about your timeline. The lender gets paid on schedule even when assets underperform brutally. Investor B takes $50,000 from a HELOC for a can't-miss rental. The spreadsheet assumes perfect tenants, stable rates. Then rates rise, rent lags, a vacancy stretches, and payments come from cash flow, not profit anymore. Nothing looks dramatic alone, but debt turns small misses into real losses that stick and snowball over months. Comparison creates the impulse. Leverage multiplies the damage. So a normal setback becomes permanent because obligations don't pause. Here's the math that wakes people up. A routine 10% drawdown on $250,000 is $25,000 gone quickly. For many households, that single move can exceed what they save in a year, which is why drops feel personal. Add leverage on top, and the hole deepens faster than contributions can fill, even with a solid income. The deeper problem is the moving target. There will always be someone richer, younger, luckier, or louder online. Iterdin. If you chase the leaderboard, You step onto a treadmill that speeds up every time you glance sideways again. So my guardrail is simple. Track inputs you control. Contribution rate, risk budget, and time to goal on schedule. Clean your feed too. Mute performance screenshots and cherry-pick trades. They're dopamine, not education or real planning. And install a 72-hour cooling-off rule for any move that adds debt or increases risk beyond your policy. Now that the traps are exposed, here's the shift that matters. $250,000 isn't a rival. It's escape velocity if protected. From $0 to $250,000 usually takes the longest because you're pushing the whole boulder uphill yourself for years. After $250,000, the portfolio has its own motor. Even average markets can move more than your paycheck some months. At an 8% long-term expectation, $250,000 can generate about $20,000 a year before you add anything new cash. Then your contributions stack on top. $1,500 a month is $18,000 yearly, a second engine for you too. This is why the next $250,000 often arrives faster. Each dollar now has more partners compounding beside it. So the smartest move is getting more boring, not more clever, as your balance grows and stakes rise. I learned this the hard way. Every tweak felt productive, until one bad month erased a year of progress. At this size, preservation beats cleverness, because every dollar lost today can cost several dollars tomorrow in compounding. That's why I want you to write a one-page investment policy. Simple rules that protect you from yourself later. Line 1 is your target allocation, like 80-20, plus rebalancing bands, like plus or minus 5% around target always. Line 2 is bold. No leverage, no margin, no debt-financed bets, because fragility hides inside borrowed money at first. If you want to rebalance, do it mechanically. When an asset drifts outside the band, you act, otherwise nothing. This captures the engine without pretending to be the mechanic. You trim heat and add when prices cool. To separate spending from volatility, decide purchases in advance, sell deliberately, and refill your allocation after taxes always. Also build real options with cash. A 6 to 12-month emergency runway buys calm and better career decisions too. That cash isn't dead. It lets you say no to bad offers and yes to better ones confidently. When markets and friends get loud, I add friction on purpose. A 48-hour hold before riskier changes anytime. Write the reason, the plan, and the exit. If it still makes sense, do it inside your sandbox. Then automate the good stuff. Schedule transfers so inertia works for you, not against you on busy weeks. If you do these boring things, $250,000 becomes a compounding machine, and your future self finally breathes easier every day. Here's a quick reality check. Your portfolio can swing more in a day than your weekly paycheck now. That doesn't mean you're rich. It means your emotions have more leverage, so your rules must tighten today. When you feel tempted to celebrate a green week, remind yourself, celebrations are funded by income, not quotes. If you want a reward, set it inside your budget, the same way you pay rent and groceries. Your investing account is for future freedom, not for mood management, and not for keeping up online either. Comparison will always find someone ahead, because the internet shows highlights, not the boring decades behind them all. So I measure progress by my controllables: contribution rate, savings buffer, and whether my allocation stayed on target. Once per quarter, I review goals, rebalance if needed, and then I go live my actual life again. If you're in a 401k, automate increases at raise time. That one habit quietly beats most strategies long term. And if you're using a Roth IRA, consistency matters more than perfect timing, because time is the advantage. Corti, at $250,000, the biggest risk isn't volatility. It's you changing course when nothing fundamental changed yet at all. Markets will wobble. Headlines will scream. Friends will brag. Your edge is refusing to treat noise like instructions. If you must change something, change it slowly with written reasons and with a deadline to reassess later. I also separate learning from doing. Read, simulate, backtest ideas on paper before risking real dollars ever again. That pause protects compounding, because compounding hates interruptions, and your future self hates regret even more too much. When I hit $250,000, I made one promise. I wouldn't let excitement become a permanent expense for me. Because permanent costs require permanent cash flow, and markets don't promise permanent green days ever at all today. So if you're watching this with $250,000, treat it like a fragile engine. Protect the parts carefully always. If you're below $250,000, bookmark this moment. Your future mind will face these exact temptations too one day. In the next scenes, I'll give you a simple 2-line policy you can copy and start today immediately. Adart. Open your Notes app and write this title: My $250,000 Policy. Because your phone is where temptation happens. Under it, write line 1. My target allocation is $0 and my rebalance band is plus or minus 5%. Then write line 2 in all caps. No leverage, no margin, no borrowed money, no debt to invest, ever. Those 2 lines do something powerful. They move decisions from feelings into rules before the market tests you. Next, add 1 sentence. I only check my portfolio on schedule, not every time I feel stressed or excited. My schedule is simple: 1 quick weekly glance, 1 monthly contribution review, and 1 quarterly rebalance check. This reduces emotional trading, because most bad moves begin with too much looking and too much interpreting noise. If you feel the itch to trade, you write it down. Wait 48 hours and reread your policy first. If it still feels smart, you can act only inside your 5% sandbox, not your core retirement base. That sandbox scratches curiosity without risking your future. Losing it should feel annoying, not life-changing ever. Now let's handle spending, because this is where $250,000 quietly creates lifestyle creep if you're not careful. Rule: any purchase funded from investments needs a plan. Amount, sell date, taxes, and refill afterward to target. If you can't write the plan in 2 minutes, you're not ready to sell. You're reacting to emotion. Your emergency fund is separate. 6 to 12 months of expenses in a safe account buys real options. That cash gives you freedom to negotiate, switch jobs, or say no without panic, which raises lifetime income. Ironically, this boring cash buffer can produce bigger wins than any clever ETF shuffle you'll try in a rush. Now let's talk about your social feed, because comparison is a risk exposure you rarely measure clearly. Unfollow screenshots, leaderboard accounts, and cherry-picked wins. They trigger urgency and make a solid plan feel slow. Replace them with a simple dashboard. Contributions this month, allocation drift, and years to goal based on realistic returns. When you focus on inputs, you regain calm. When you focus on others, you inherit their pressure and risks. Now I want to give you 3 questions that instantly reveal whether a move is smart or just anxiety disguised. Question 1. Does this decision increase my fixed monthly costs based on market gains that could disappear next week? Question 2. Does this decision add leverage or concentration that could turn a normal dip into years of recovery? Question 3. Would I still do this if nobody could see it, and I couldn't post results anywhere online? If any answer makes you uncomfortable, pause. Discomfort is data, and your policy exists to protect you here. Remember, at $250,000, you're not trying to impress anyone. You're trying to build freedom you can actually keep. Freedom means your money works quietly while you live. It doesn't mean constant decisions, stress, and chasing. This is why boring scales. Automatic contributions, low costs, and rebalancing capture the engine without ego. Speculation doesn't scale the same way. It needs attention, perfect timing, and luck, and it taxes you emotionally. So if you feel bored, good. Bored means your system is working, and your future self is getting safer. When markets drop, your job is not heroics. Your job is staying solvent, staying employed, and staying consistent. If you want to accelerate, Accelerate your income and savings rate, not your portfolio's risk level or leverage. Most people underestimate career compounding. Raises, skills, negotiation, and switching jobs can beat risky trades over time. Your portfolio is the second engine, but your paycheck is still the steering wheel, especially before full financial independence. Keep investing simple enough that you don't need motivation. You only need a calendar reminder and automation. Once a year, increase contributions when you get a raise. That's a strategy you can repeat for decades. And if you're tempted to chase a hot sector, remember, the hottest stories usually peak right before regret begins. Your edge is refusing to confuse excitement with opportunity. Real opportunity survives boredom, scrutiny, and time. In the final scenes, I'll summarize the 6 boring rules and give you a 1-minute action plan. Because $250,000 isn't a finish line. It's the point where restraint becomes the skill that changes everything. Let's lock this in with 6 rules you can remember even when markets are loud and emotions spike. Rule 1. Quotes are not cash. A green day is information, not permission to spend or celebrate. Rule 2. Never convert temporary gains into permanent costs. Lifestyle upgrades must come from stable income. Rule 3. Keep the core boring. Broad index funds, low fees, automatic contributions, and minimal decision points. Rule 4. Rebalance mechanically using bands. Act only when drift breaks the rule, otherwise do nothing. Rule 5. No leverage, no margin, no debt-financed investing, no clever borrowing that adds fragility quietly. Rule 6. Sandbox curiosity at 5%. Learn and experiment without risking the compounding engine you worked for. Now here's the 1-minute plan. Write your 2-line policy, set your check-in schedule, and automate contributions today. Then mute the accounts that trigger comparison, and replace them with a quarterly dashboard focused on your inputs. If you want to purchase from investments, write a sale plan first. Amount, timing, taxes, and allocation refill. Build a 6 to 12-month emergency runway. That cash buys calm, flexibility, and career leverage when life surprises you. And remember, the real flex at $250,000 is not speed. It's stability when other people get pulled into noise. I've seen investors lose years chasing shortcuts, but I've never seen boring consistency fail over decades of compounding. If you're at $250,000, you're not late. You're ahead of where many households ever get, so protect it. If you're below $250,000, this is your map. Build the base calmly, then get even calmer when you arrive. Crossing $250,000 isn't arrival. It's access. Access to momentum, to compounding, and to choices that stay yours. So treat your attention like capital. Don't waste it on constant checking, and don't rent it to social media. If this helped, type policy in the comments, and I'll pin a simple template you can copy today. Like this video so it reaches someone who needs calm investing, subscribe for new videos, and I'll see you next. And remember my favorite line: reversible gains, irreversible spending. Stay boring, stay consistent, and let time do the work. Before you go, take 10 seconds and screenshot these 6 rules. Keep them for the next Red Week. If you're nervous right now, that's normal. It means you care, and caring is why we build guardrails. The goal isn't to feel fearless, it's to feel prepared, so your plan survives moods and headlines too. Next video, I'll show what changes again at $500,000 and how to keep compounding without burnout for real. Until then, remember, your best investments are time, consistency, and the ability to ignore crowds when they scream. When you hit a milestone, celebrate with something small and planned, not something that creates monthly payments forever. If you want accountability, tell me your 2-line policy in the comments and I'll reply to a few. And if this video stressed you out a bit, good, because awareness is the first step to protection today. You already did the hard part by building the base. Now you just have to not break it. Set the automation, close the app, and go live. Your portfolio works best when it's boring in the background. If you check markets daily, Replace that habit with one weekly reminder. You'll feel calmer within a month. Keep learning, but separate learning from doing. Paper test ideas first, and protect your core like it's sacred always. The boring path isn't popular, but it's repeatable, and repeatable beats exciting when you're building a million slowly. At $250,000, you're effectively halfway to $1 million in time, even if the dollars don't look like it yet. So don't chase shortcuts. Protect momentum, keep contributions steady, and let compounding do what it always does quietly. If you want my template, I'll pin it. Just comment policy, and I'll drop the exact 2 lines below. Thanks for trusting me with your money journey. You're building something rare, and I want you to keep it. Like, subscribe, and I'll see you next week. Until then, stay boring, stay safe, and stay invested always. One last reminder. The market will test you, but your policy will protect you when feelings can't today. Congratulations again on $250,000. Now guard it with rules, not emotions, and let your future arrive calmly soon.